Sorry about that. I got cut off. The film ran out. But we were talking about the arithmetic mean versus the geometric mean, and we're very used to the arithmetic average, so I'm not going to get too in depth into that. I already discussed it. The geometric average is the average compound return per period over multiple periods. And this is going to answer the question, what was your average compound return per year over a particular period? The geometric average will be less than the arithmetic average unless all returns are equal. So to actually compute the geometric average, this is what the computation looks like, where you have 1 plus the return in each period, and you're multiplying them out over an interval of t, and then you're going to take the square root of 1 over t and subtract 1. Now, I want to emphasize that this formula is, it's good to be introduced to. So that's all we're doing here is just an introduction. This is not something that we're going to be dealing with on a daily basis going forward. So it's just an introduction at this point to what the geometric mean looks like and its formula and so on and so forth. So this is what this previous formula, if you'd like to put it in more of a compact form, this is what it would look like. So this means exactly what we saw in the previous chart, except we're entering into this pi variable. If you recall back, we used sigma a lot, and it means the same type of thing, except sigma meant sum, and pi here is going to mean multiply, so you see product. Once again, this is not something that we're going to be getting too in depth in, but it's good to be introduced to. And the reason that it's being introduced here is, once again, we've dealt with compounding in the course. So which is better, the arithmetic or geometric mean? The arithmetic average is overly optimistic for long horizons, and that's one of the reasons we use the arithmetic mean so often, is because it's more of a short-term description. The geometric average, however, is overly pessimistic for short-term horizons. So what's best, it depends on the planning period. If it's under 20 years, typically you should just use the arithmetic mean. If it's 20 to 40, you can split the difference between them, and if it's 40 plus, you could go ahead and use the geometric mean. The last portion of this chapter gets into the efficient market hypothesis. The efficient market hypothesis gets into the fact that a market in which current prices fully reflect available information is what we typically see. So in such a market, it's not possible to divide trading rules that constantly beat the market after taking risk into account. That's the thought of efficient capital markets and the efficient market hypothesis. In a sense, stocks are fairly priced and everything's informationally efficiency, or involving informational efficiency. So if this is true, you should not be able to earn abnormal or excess returns. And efficient markets do not imply that investors cannot earn a positive return in the stock market. So this next chart gets into a reaction of stock prices to new information. In a truly efficient market, stock prices would react immediately and sharply to new information, setting into a new equilibrium price. And this is shown by the solid line on this chart. The dotted line shows an over or under reaction to the news. There's several forms of market efficiency. The first is strong form efficiency, and here all information, both public and private, is factored in. Semi-strong form efficiency is where all information is factored in, and weak form efficiency is where all market information, including prices and volumes. So the efficient market hypothesis, this is asserting that modern U.S. stock markets are informationally efficient. An important implication of this is that financial securities are zero NPV investments. Why is that? Because if price equals the market price, then NPV should equal zero. The expected returns on securities is their risk-adjusted required return. Okay, so digging in a little bit more in depth into each of these. Strong form efficiency. Here, prices reflect all information, including public and private. And if it's true, then investors cannot earn abnormal returns regardless of the information they possess. Empirical evidence indicates that markets are not strong form efficient. Insiders can earn abnormal returns, which may be illegal. How about semi-strong form efficiency? Semi-strong form efficiency is a situation where prices reflect all publicly available information, including trading information, annual reports, press releases, and etc. And if this is true, then investors cannot earn abnormal returns by trading on public information. And this implies that fundamental analysis will lead to abnormal returns. It implies that fundamental analysis will not lead to abnormal returns. The evidence is mixed for this one, but it does hold in a lot of cases. And finally, weak form efficiency. Here, prices reflect all past market information, such as price and volume. And if this is true, then investors cannot earn abnormal returns by trading on market information. This implies that technical analysis will not lead to abnormal returns. Empirical evidence here indicates that markets are generally weak form efficient. So, this next chart kind of highlights everything we've discussed as far as the efficient market hypotheses, where you have in the middle weak, which is security market information, and the blue we have semi-strong public information, and then strong is in the red, which is the outward circle where you have public and private information. We're going to end here. This chapter ends with this last slide. Common misperceptions about efficient market hypothesis. Efficient market hypothesis does not mean that you can't make money. Efficient market hypothesis does mean, on average, you will earn a return appropriate for the risk undertaken. So there's no bias in prices that can be exploited to earn excess returns. And finally, market efficiency will not protect you from wrong choices. If you do not diversify, for example, you still don't want to put all your eggs in one basket, and that's something we're going to discuss more and more as we move throughout the course. So that we'll tap all. We're finishing chapter 10 with this slide, and with the next couple videos, we're going to move into chapter 11. Thanks.